Hi everyone, Jason Schenker here, President of Prestige Economics and Chairman of the Futurist Institute. I wanted to share a few top-line thoughts about the economic data coming in the week ahead. The most important releases will include Q4 2023 GDP, the PCE and PCE Core, personal income, personal spending, and initial jobless claims. Those will be the most important economic data coming in the week ahead. GDP, let's start with that. In the third quarter of 2024, it was 4.9%. This was a blowout number. The Atlanta Fed GDP now, based on the available data through January 18, 2024, reflects that Q4 2023 GDP is likely to be 2.4%. The Atlanta Fed GDP now has a pretty good track record, so the number somewhere between 2 and 3% wouldn't be an unreasonable expectation. I would also point out, though, after a 4.9% blowout in the third quarter, almost any positive number for Q4 is a really strong sign for the economy. Right? 4.9% is a mind-blowingly strong number, especially at this point in the cycle with such high interest rates. If we were to get a 2.4% number, plus or minus, that would be really solid for the economy. That would also take pressure off the Fed to cut rates imminently. The labor market, that's the other area where the Fed's focused. Looking at those jobless claims last week, 187,000 initial jobless claims, the second lowest level since September 1969, and jobless claims falling to 1.806 million. That's less than 1.1% of the entire labor force of 168.1 million who are collecting unemployment. Only 1.806 million. Very low numbers. So we are at full employment, especially with a 3.7% unemployment rate, ongoing payroll gains, even though they've slowed, and almost 8.8 million open jobs in the month of November. So jobs are good, but inflation is what the Fed is worried about. And they'll be watching very closely what happens in the PCE and PCE Core reports this week. Inflation rates are likely to rise modestly, but they're going to be comparing what happens with these numbers to what happened with the CPI. You remember we saw that acceleration in headline CPI from 3.1% in November to 3.4% in December. That's moving in the wrong direction. It's also nowhere near the Fed's 2% target. We think about CPI Core, that excludes food and energy prices, and that fell, but only modestly from 4% down to 3.9%. And of course, 3.9% is also nowhere near 2%. Watching those year-on-year rates from the PCE and the PCE Core will help provide information and insight into where the Fed might be thinking for policy. But they're not going to need to cut rates imminently because of the job market, and they're not likely to need to cut it because of growth. Plus, financial markets have remained relatively strong, although they've fallen recently, on expectations the Fed will keep interest rates higher a little bit longer than most anticipate. We expect the next Fed rate cut most likely in Q3 2024, but it is possible we could see one in June of 2024. Around the mid-year is what we expect headline CPI to be back down to 2 to 2.5% year on year. That's near the Fed's 2% target. Core CPI, we don't expect to see that until Q3, and at the 2 to 2.5 level, that means we don't expect Fed rate cuts until we're close to those targets, especially with a record $34 trillion plus in government debt, federal debt, and $17 trillion plus in consumer debt. These kinds of debts need to be refinanced, and debt burdens rise when interest rates are high. This is why it's important to get inflation down so that interest rates can fall, on the belief that the Fed will be keeping their hand on the rudder of inflation, keeping inflation near that 2% target. If there is faith restored and confidence in that number, then interest rates fall, and that will reduce the debt service costs on such a high burden of debt, both for the federal government and consumers, and of course, business debt and the like. So in the long run, we do believe we are going to get the inflation numbers down. But in the short term, we think it's going to take a little while before the Fed gets there. You'll be watching for this in the PCE reports this week. And of course, people will also be watching the jobless claims numbers to see if there's any kind of major reversal. But I think we're still going to see them remain very low and reflect strength in the labor market. Thanks for watching, and follow for more.